Hello and welcome to the Harwood Report for February 26, 2019. I am Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. As always, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of these disclosures. All right, guys. We've got some interesting stuff going on. I'm going to talk a lot through the equity indices. Gold and silver have been reluctant to do what my signals say they should be doing. So we'll take a look at this kind of closely today. We also know yesterday that President Trump, said he felt that oil prices were too high and that OPEC needed to help bring them back down. That hit USO. It actually didn't really hit the oil equities that much, though. So we'll take a look at that and see kind of what's going on there. Before I get into the charts, I always like to look at fear and greed, and we're getting frothy here. It's getting pretty high. You look at this market breadth. That is extreme greed now. We got down towards the zero line, and then look how much strength has come back into this market relative to what we've seen over the last year. It's incredible how much participation is happening here. On top of that, new 52-week highs, they are starting to kick back in. So that big washout has been resolved. Now we're back kind of where we normally would be. So yeah, it could be considered extreme greed relative to this stuff, but it's just, I think, on the greed side as opposed to extreme greed relative to what we saw last year. This is just average. I mean, we're not worrying about the hedging like we did in December. It's just back to normal levels. This is just at normal levels and doesn't matter. This is at normal levels and doesn't matter. And then the VIX is starting to get low, but it's not all the way down there. I'm looking for this to get down towards 12, honestly. And I'll look a little bit more at that and the next thing. And obviously, the S&P 500 is above the 125-day moving average. I have no idea why they would still label that as fear. There's nothing in this chart that looks fearful on the S&P 500 relative to its moving average. But in any case, we are getting to that point where maybe the market needs to slow down a little bit based upon some of these metrics. And then when we actually look at the market, I think this is a natural stall point for the market. We're close to the November high, close to the December high, and we've made a lot of progress since the December low. Okay, so this was fast. It's starting to slow down. It's starting to taper off. The moving averages are starting to come back around. I think we want to see this 50-day moving average get back a little closer to the market. You know, the 10 and the 20 have been, or really the 10 has been the guidepost for the last month and a half. But I think the market's going to want to do a little bit of work now and allow some of the other moving averages to catch back up. Some of these ones that had fallen off relative. So what does that mean? It means that, yeah, we can continue to grind higher, but I think it just slows the momentum. So I think we can kind of keep going here towards that 285, 286, 287 level, especially if we can get a little bit more of an oomph here. I mean, we had a little consolidation and then a bump, a little consolidation and then a bump. I think that's kind of the way we think of this now, is more of a stair-stepping approach as opposed to a rocket. So go up a little bit and then sideways a little bit and up a little bit and sideways a little bit. And so if I'm looking at that and I'm seeing the VIX where it is and saying, okay, well, the VIX has a little bit of downside here on a stair-stepping approach, I can do some stuff where maybe I'm using a call spread or a call butterfly or a call calendar. I mean, there's all these different ways that I can put this together. And I talked through the idea that I had in the premium product. For you guys, I'll just focus on the technicals and the fact that there are some really interesting ways to play options when the thesis is more of a stair-step approach to the market. Okay? When I look at a couple of others here real quick, IWM, just as our small cap indicator, it is above the November high now and is well above the December high. So that's showing some strength relative to that time of the year, but also remember that this had basically led the market down. So it had a lot larger break, and as a result, it's just above the 200-day moving average now. The 10-day is not above the 200-day, nor is the 20-day moving average, because it just had such a great fall relative to SPY, relative to S&Ps. When I go to the Qs, you'll see here, I don't know if I got that pulled up right here. Let's try this again. Yep, there we go. The Qs. You'll see here that this is similar to these stories as well. Above the December high, below the November high. We've gotten above the 200-day moving average. The 10 and the 20 are catching up to the 200-day moving average. So all of these indices are doing that. But one of the ones that I think a lot of people like to use as a bellwether for stocks is SMH, and that has had a full recovery. So we're back near, kind of into the range we were trading last year, rather than down, at the like 99 level would be in line with where the rest of the market is trading. So it tells me that the semiconductor sector, which had gotten hit a lot on fears over the China trade situation, has already gone a full recovery and is impressing again. So if this is going to impress, that tells me that the economy is back, or is not in as much danger, or at least the market doesn't believe the market's in huge danger here, and we can start focusing on the market grinding higher. All right, so all of this is built on the idea that the market should continue to grind higher. When I go to bonds, they're in a range, they're not moving, they're not exciting. Okay, I'm not going to spend a lot of time on bonds because there's nothing happening here that makes me excited about any sort of trade. But I will go over to gold. And before I go to gold, I like looking at the dollar. So we'll look at the dollar index. And you can see here that the dollar index is kind of drifting in the middle of its range. And dollar yen, which is down a little bit today, but continues to seem like it's going to drift higher. Okay, so the signal for me has been that gold short makes sense. Notice that we're basically in dollar yen, kind of right here at the end of year level. Okay, but when we look at GLD, end of year level puts us down here towards 121. So if this is just off of dollar yen, then gold has $4 of downside. If we're just off of the dollar, gold has $4 of downside. So there's been some investor demand clearly this year. People rotating their portfolios, adding maybe some precious metals, adding some diversification based upon, I think, a lot of what happened in December. That move has helped basically get gold up from the low 110s up to 125. It's a good 10 to 15% rise in prices. Okay, so we're back to where we were at the shop point of last year in the April range. But with the dollar continuing to be kind of range bound but not bearish, and dollar yen continuing to grind higher, I think we could see some fall off in gold here. I'm not talking about back to 112, 113. I think that was probably a bit too extreme, and people aren't going to just pitch all the gold in their portfolio, a month or two after they started allocating. But what you could see is some of that hot money that was trying to chase gold, thinking about that potential for a move into the 130s, 135 range. I think that can start pulling it back, and we could look down towards 121 in relatively quick order. It has been something I've been looking for a while, for a couple of weeks now. I thought that this was going to be that rollover point. It didn't happen. We spiked instead. I thought this might be that rollover point, and now I think this could do it if we can get below the 20-day moving average is the key. So they haven't been below the 20-day moving average since we got this kind of volatile spiking move. Now, this increase in volatility tells me that there's some weird money flow in gold. And as that increase in volatility basically drifts down and the gold prices start to drift down, I think we can really just see that break happen. Okay, so that's where I'm thinking about a move down here towards 121, 122. Hang out down here for a little bit of time, probably consolidate based off of this stuff. And then maybe we can do another leg lower. It could just be a lot like this, where we get a kind of a gap down. Maybe it's going to happen, not going to happen until non-farm payrolls on March 8th. Maybe it happens before. But then we can hang out for about a month and then start another big collapse if the global economy is fine. Okay, so that's basically the way I'm looking at the gold market, is that I don't think this is a long-lasting bull market in gold. I think we're wrapping up the bullish flow. Let's do oil, and then we'll get on our way here. But in oil, so it looked like everything was going to be great on Friday. We got through the 100-day moving average. All this stuff starting to get a little bit of a breakout from this recent choppy range. And then we get the announcement from Trump that he thinks oil prices are too low and he would like OPEC to do something about it. Well, that caused a fall back below the 10-day moving average, but the 20-day held. We didn't even test the 50-day. Everything looks okay here as long as this continues to hold up. So excuse me, if this is holding up, I think we're setting up for a bounce back into this $11.95, $12 range, and then we'll see what happens. But unless OPEC actually responds to President Trump's request, I think that oil can go back higher. Oil was back up here. USO was up here 3 months ago, 4 months ago. So it did have a big break in November and December. But if I look at like the oil futures, what is it, CL? Crude Oil Futures, you can see on a continuous basis, we were talking about $70, $75 oil, and right now we're at 55. So I don't know that OPEC is going to sit there and say, oh, 55 is way too high. They might have felt that at 75, that it was a little too high, but I don't think 55 is high enough that they are going to feel that pressure. Okay, so that means that maybe the reaction here in XLE yesterday, where it was pretty stable, made some sense. Trying to create some support here at the 10 and the 20-day moving average. We're not back to the 200 like we were in these other sectors. So maybe, just maybe, people are going to start allocating some money into oil based upon the assumption, the realization that OPEC's not going to get crazy about increasing production and driving prices down at $55. This fall got extreme because it was happening while the markets were falling and while oil was falling, and maybe people are going to start allocating to a different type of commodity producer rather than the gold market. Start looking at these oil producers. And the other one that gets exciting for me is really OIH. This one tends to lag a little bit, and you can see that it is kind of hanging a little bit lower overall. But if we can start seeing this price get above this February 20th high, which was 1806, I think we have some spike risk in OIH, maybe into the 21 range, 22 range. That can really be played well with options because options give a lot of leverage when we've gotten this kind of tight coil and then start looking at a breakout. So speaking of that, that's the Harwood Report premium product. I talk more about how I am looking at structuring these trades with options based upon the technicals and the option markets. You get a week for free. After that, it's only $49 a month and can kind of help guide you guys along in your understanding of how I combine technical analysis and options analysis in order to create these great option structures that can leverage that edge. Now, I also do a midweek update. I also have that. So I have the newsletter that I put out on Mondays. I do a midweek update for subscribers only. All of this stuff comes along for that $49 price point. So it's a pretty good value overall. If you have questions, feel free to email me, keith@tradeacademy.co, and I will get back to you. Probably the quickest that way. Or you can always call me, 312-600-8004. Thanks again, folks. We'll talk again next week.